Most people think money is printed by governments. Not really. Most money is created by banks. It's a process shrouded in mystery, often misunderstood. But understanding how money is created is crucial to understanding our economy. It's about more than just numbers. It's about power, value, and the very fabric of our society. Think of it like this. Banks are like financial alchemists. They take something ordinary, like a deposit, and transform it into something extraordinary. New money. This isn't magic, though. It's a system with rules, risks, and real-world consequences. Here's how it works. When you deposit money in a bank, it doesn't just sit there. Instead, it becomes part of a larger financial system that helps fuel the economy. The bank keeps a fraction of your deposit as reserves, required by the Federal Reserve. This ensures that banks have enough cash on hand to meet the withdrawal demands of their customers. This is called the reserve requirement. It's a regulation that mandates banks to hold a certain percentage of their deposits in reserve, ensuring stability in the banking system. The rest, they lend out to other customers. This lending process is crucial for businesses and individuals who need funds for various purposes, such as buying a home, starting a business, or paying for education. This is how banks create money. By lending out a portion of the deposits they receive, banks effectively increase the money supply in the economy. Let's say you deposit $100. This simple act sets off a chain reaction in the banking system. The reserve requirement is 10%. This means the bank must keep $10 in reserve and can lend out the remaining $90. The bank keeps $10 and lends out $90. The borrower then uses that $90 for various expenditures. The borrower spends that $90, which ends up deposited in another bank. This second bank now has new deposits to work with. That bank keeps $9 in reserve and lends out $81. This process continues with each subsequent bank keeping a fraction in reserve and lending out the rest. This process repeats, creating new money with each loan. The initial deposit of $100 can multiply many times over through this system. This is called fractional reserve banking. It's a system that allows banks to lend out most of the deposits they receive, while only keeping a small fraction in reserve. It's a system where banks only hold a fraction of deposits in reserve. This allows them to use the majority of the deposits to create new loans, which in turn stimulates economic activity. The rest is used to create new loans and therefore new money. This cycle of deposits and loans is fundamental to the functioning of modern economies, enabling growth and development. At the heart of this intricate financial system is the Federal Reserve, America's central bank, often referred to simply as the Fed. Established in 1913, the Fed plays a crucial role in maintaining the stability and integrity of the US economy. Contrary to popular belief, the Fed doesn't print dollar bills. That's the responsibility of the US Treasury Department, which handles the physical creation of currency. Instead, the Fed controls the money supply through other, more sophisticated means. Primarily, it sets interest rates and reserve requirements for banks, which in turn influence the amount of money circulating in the economy. Think of the Fed as the conductor of an orchestra, where each instrument represents a different economic tool. They use their instruments, interest rates, reserve requirements, and open market operations, to fine-tune the economy, ensuring it runs smoothly and efficiently. Their ultimate goal? To achieve stable prices and maximum employment, creating a balanced and thriving economic environment. By lowering interest rates, the Fed can increase the money supply, making borrowing cheaper and encouraging both consumers and businesses to spend more. Conversely, by raising interest rates, the Fed can decrease the money supply, making borrowing more expensive and thereby slowing down inflation. It's a delicate balancing act requiring constant vigilance and adjustment to navigate the complexities of the modern economy. The Fed's decisions ripple through every aspect of financial life, from the interest rates on mortgages to the returns on savings accounts. Every move is scrutinized by economists, investors, and policymakers alike, highlighting the immense responsibility shouldered by the guardians of the money supply. When the economy slows down, the Fed might print money electronically to stimulate growth. They do this by buying government bonds or other assets from banks, injecting new money into the system. This lowers interest rates, encouraging borrowing and investment. But printing too much money can lead to inflation, where prices rise faster than wages. This erodes purchasing power, making it harder for people to afford goods and services. It's a delicate dance. Too little money and the economy stagnates. Too much and inflation runs rampant. The Fed walks this tightrope, trying to keep the economy humming along. Section 5. Inflation, the silent thief in your wallet. Inflation is often called a hidden tax. Why? Because it erodes the value of your money over time. Imagine saving for a car. You finally have enough, but due to inflation, the car now costs more. Your money has lost purchasing power. This affects everyone, especially those on fixed incomes. Their money buys less and less each year. Inflation is a silent thief, slowly eroding the value of our savings and earnings. Section 6. The money multiplier effect ripples in the pond. The money creation process doesn't stop with a single loan. It creates a ripple effect throughout the economy. This is known as the money multiplier effect. Remember our earlier example? The $100 deposit led to $90 in new loans, then $81 and so on. The total amount of money created is much larger than the initial deposit. This multiplier effect amplifies the impact of the Fed's actions. A small change in the money supply can have a large impact on the economy. Section 7. The velocity of money, speed dating for dollars. The speed at which money changes hands also affects the economy. This is called the velocity of money. When people are confident, they spend more, increasing the velocity of money. This boosts economic activity, but when confidence is low, people hoard cash and the velocity of money slows. This can lead to economic stagnation. The velocity of money is a key indicator of economic health. Section 8. The debt-based monetary system, a house of cards. Our current monetary system is debt-based. Most money is created through loans. This means that debt is an inherent part of the system. This can lead to unsustainable levels of debt, both for individuals and for the economy as a whole. Some argue that this system is inherently unstable. Others argue that it's the engine of economic growth. Regardless, understanding the debt-based nature of our monetary system is crucial. Section 9. The Canelon Effect. Who benefits from money creation? Not everyone benefits equally from money creation. The Canelon Effect argues that those closest to the source of new money benefit the most. This includes banks, financial institutions, and those who receive loans first. Those further down the line, such as wage earners and those on fixed incomes, may experience the negative effects of inflation before they see any benefits. This raises questions about fairness and equity in our monetary system. Section 10. Conclusion: Money matters. Money creation is a complex process with far-reaching implications. It involves a series of intricate steps and decisions that impact every aspect of our financial system. Understanding how money is created is essential for understanding our economy, inflation, and the distribution of wealth. Without this knowledge, we cannot fully grasp the forces that shape our financial landscape. As we've seen, money isn't just printed by governments. The process is much more nuanced and involves various financial institutions. It's created through a complex interplay between banks, central banks, and the public. Each of these entities plays a crucial role in the money creation process, influencing how much money is in circulation. This system has its advantages and disadvantages. On one hand, it allows for economic expansion and the ability to respond to financial crises. It can fuel economic growth, but it can also lead to instability and inequality. The concentration of wealth and the potential for financial bubbles are significant concerns. As we navigate the 21st century, it's more important than ever to understand the power and perils of money creation. With the rise of digital currencies and global financial integration, the landscape is continually evolving. The future of our economy may depend on it. By staying informed and engaged, we can better prepare for the challenges and opportunities that lie ahead.